Hey, welcome back to the channel. I hope you're having a great Memorial weekend so far, and special shout out to all the veterans and those that have served this country. I encourage you to watch till the end of this video, as I'll share a special story about a World War veteran that actually made millions from one simple investment. And I'll also talk about two of my personal stock picks. When it comes to long-term investing, one of the most powerful ways you can transform your portfolio is through dividend investing. Take it a step further, and you'll change your entire future with the power of DRIP. I want to thank everyone supporting the channel, as we just hit over 200 subscribers. This is a big milestone for me, starting a little over a month ago, and I appreciate each and every one of you watching. If you're new, hit that subscribe button and bell notification to keep up with my future videos. If you've been watching so far, I appreciate you rocking with me, and keep hitting that like button, as it really helps me out. You might be thinking, what's drip exactly? Now, I'm not talking about slang for high fashion, or the drip that rappers often mention in their songs. I'm talking about a different type of drip, something known in the investing world as a dividend reinvestment plan. With this, you're taking cash dividends, whether it's paid out monthly, quarterly, or semi-annually, and reinvesting it to buy more stock of the company paying out those dividends. Doing this heavily depends on the strategy that you choose, and it depends on the stock performance. You can implement strategies that work best for you, like a full investment if the stock is growing at a healthy growth rate, a partial dividend investment if you want to use some free cash flow to also buy shares in other companies, or no reinvestment at all if you just want to collect a consistent stream of revenue for personal savings or expenses. In one of my previous videos, I've also talked about dollar cost averaging as a technique to buy parts of a stock in order to smooth your cost basis as the price moves up and down. Well, DRIP actually uses this exact technique alongside fractional investing to automate compounding interest, one of the most powerful forms of a return for investors. Double compounding is something that occurs when you're invested in a stock that normally grows its share price, while also growing its dividend yield each year too. Take a look at the graph and see the difference in these three scenarios. The smallest growth is with reinvested dividends that have a stagnant yield. A slightly higher return comes with stocks that grow their dividend yield, but the dividends aren't being reinvested. And the highest potential of return comes with stocks that grow its dividend yield each year, while the dividends are being reinvested too. Think of the snowball effect, how something can build upon itself continuously if left alone. Similarly, reinvesting your dividends uses exponential growth. Any gains on your investment gets rolled over into fraction of new shares, which then grow and yield even more fractions of dividends, which then grow more into new shares, rinse repeating until you stop the drip or the company itself cuts off the dividend payment. Let's use a hypothetical example, the Paytient company, to visualize what I'm talking about. Say this company offers a dividend payment of $1 per share annually. To keep things simple, we'll assume the stock price increases by 10% each year, and the dividend rate grows by 5 cents each year. You initially invest $10,000 when the stock price is at 20, so you end up with 500 shares in total. At the end of the first year, you receive a payment of $1 per share, which comes out to a total of $500 in dividend payments. It's year 2, and the stock price is growing and is now at $22, so your reinvested dividends buy an extra 22.73 shares. The remaining 0.73 shares is bought thanks to fractional shares, commonly available in most dividend reinvestment plans. At the end of the second year, you earn $1.05 per share in dividends. This time it's earned on 522.73 shares, so your total dividend payment for the year is $548.86. It's year 3, and the 10% growth rate is still there, and shares are now trading at $24.20. So reinvesting this dividend buys another 22.68 shares. You now own 545.41 shares in total. 3 years after your initial investment, you're earning $1.10 in dividends per share, which comes out to $599.95 in dividend payments. Since the stock price has risen to 26.62, this dividend payment will buy another 22.54 shares. Now, after just owning this stock for a few years, your investment has grown from 500 shares to 567.95 shares. With the stock price gains and your dividends reinvested, the value of your investment has grown from $10,000 to $15,118.83. If you had not invested your dividends, your investment would have only been about $13,310, a difference of about $1,808.83, just because of DRIP. Now, many of you might be thinking, this isn't as much and you could have made a lot more with growth stocks in the time period. Which is true if you had especially invested in companies like Amazon or Tesla before they blew up to high valuations. But the example I shared is small in terms of time frame. When it comes to DRIP, the real value comes especially in the nest egg it builds after many years of growth from your initial investment. Dividends are nicknamed mailbox money for a reason, because it's a part of your portfolio that you're not really actively monitoring, yet DRIP automatically accumulates shares for your behalf. I wanted to share the really cool story of the late Russ Gremmel, an ordinary investor who proved how successful dividend investing could be. Gremmel had bought Walgreens shares about 70 years ago, with an original investment around $1,000. His reasoning was very simple. People would continue to need medicine, and women would buy makeup. As he grew older, so did Walgreens' chain grow successfully, and his small investment had turned into $2 million over the course of time, because of stock price growth and dividends compounded. Gremmel was a simple man, and he maintained a low cost of living. He served in World War II, and he came back as a hero. He then practiced as a lawyer, and eventually retired at the age of 45 to focus on the things he had a passion for, such as nature, mentorship, and reading. He never cashed out once, and in fact donated all of his stock to a wildlife refuge, a sign of his great generosity. If you want to read more about him, I've attached a link in the description below. I personally find it humbling to read about dividend investor success stories, because many of them are some of the most ordinary people that prove you can make millions in your lifetime, only needing a small initial investment in a quality company, a little luck, and a whole lot of patience. Now, when it comes to my investment style, my portfolio is heavily weighted towards growth because I'm still young and I want to take more risk. However, this doesn't mean I'm avoiding the safety of slower returns from dividend stocks, as I'm slowly growing that portion of my portfolio as well. Since the March crash, I've managed to build small positions in certain companies that I think will continue to grow their dividends at a healthy rate. I'm building this in TD Ameritrade, and I wanted to share two of my picks from that portfolio today. These stock picks are Realty Income and Iron Mountain. Realty Income is a real estate investment trust, also known as a REIT stock. The company is known for providing consistent monthly dividends, which are still being paid out despite the recent down market. I really like this one because I believe the value in buying opportunity is still there. While it's a riskier option because of the uncertainty around the real estate market, I'm more interested in the stock's diversification in the real estate holdings. The company has provided 14.6% in compounded average annual return and 4.5% in annual dividend growth rate since it first listed on the New York Stock Exchange in 1994. The company is close to about 600 consecutive months of dividends being paid out, with the 599th dividend just announced 2 weeks ago. Now, this is pretty impressive growth, considering they survived through the 07-08 Great Recession, managing high returns over low debt, on top of increasing their dividends consistently. The reason is because they don't just own retail properties. They strategically own properties in commercial businesses, in the industrial, office, and agricultural sectors across the US, United Kingdom, and Puerto Rico. Taking a look at their tenants, the top 20 sources of revenue come from brands like Walgreens, 7-Eleven, Dollar General, FedEx, and many more. They have growing diversification in many industries, not subject to just major weakness in one area, a sign that they're well prepared for taking hits in some sectors that could be stagnating in rent payments. The portfolio occupancy has been very strong, with consistent tenants needing space, and they've managed to accumulate over 6,000 properties over time. They have an extremely small percentage actually being vacant and not in use. The stock price is trading around 2018 levels again, currently in the 50s range, dropping from an all-time high of 84.92 at the beginning of this year. While the stock could drop a bit more if the real estate market takes some hits, I think it's still at a good price to start adding because of the dividend value. The balance sheet is very healthy, and they won't be at risk of any bankruptcy unlike smaller REIT stocks. With businesses expected to be in operation and many already having taken loans or the necessary measures to pay their rent going forward, Realty Income is in a good position to increase their share value again, with time and consistency. The next stock I'm buying for dividend growth is Iron Mountain, an enterprise information management company. They are best known for helping businesses protect confidential information through physical and cloud facilities, maintaining a huge customer base, and expanded portfolio of offerings. In my opinion, this stock is flying under a radar with a safe dividend yield of 10%. With data centers becoming even more crucial as companies switch to a digital landscape, Iron Mountain's growth story is not over, especially after they just refreshed their business model to invest in core strengths. The dividend has been increasing, and they've paid them consecutively for 10 years so far. While the average annual return may not seem as much, the dividend payout is actually pretty impressive, and nearly as much as what realty income provides, while taking into fact that Iron Mountain stock is trading at half of the price. Of course, a lot of this will depend on if Iron Mountain can sustain their dividend in the long term, but with the recent declaration untouched, I think this won't be a problem as businesses start to pick up again. Iron Mountain has been a key player in the COVID-induced world, partnering with Google in machine learning and AI insight, providing data migration and workflow automation expertise, as well as data restoration and destruction services. They serve many key industries in technology, finance, government, healthcare, and so much more, ranging from small to large-sized businesses with many needs. This is actually really diverse and another example of the stock that can handle business slowdown in any sector by still continuing business in other sectors. The company has continued building a strong pipeline of facilities in areas like Amsterdam, London, Singapore, and even within the US, in North Virginia and New Jersey, not showing any weakness at all. The stock is trading really cheap right now, compared to all-time highs in the 40s range. It's dropped nearly 40% since the March crash, and it's only rebounded about 10%, compared to the overall S&P 500 having already bounced back 30%. This is a huge signal that the stock price is still lagging in terms of fair value. And that's why I'm thinking of adding a lot more if the stock can make a slow but steady comeback in the long term. The company has $153 million in cash on hand and $1.1 billion available in a revolving credit facility for any emergency situation. They've even managed to keep 96% of their facilities open, with data center demand skyrocketing as businesses were forced to go remote. Let me rephrase that because I really want to stress how important that statement just was. This company actually stayed open compared to many companies forced to shut down. Because of that, I really don't think the business is going anywhere. In fact, it should be even getting bigger from now. And I'm betting on this being reflected in the share price sooner or later. That's it for my stock picks and the overall lesson on why dividend reinvesting is so powerful. I really hope you enjoyed this video, and I encourage you to start building your own dividend portfolio for the long term. Even if you want to focus on growth stocks instead, do this for someone else in your family or your friend and teach us something new. Dividend reinvesting is a lot slower, but it's safe as well, and really good alternative for retirement. Trust me, it'll really be worth it. Leave a comment below on what you thought of this video, and remember to hit that like button, especially from my man Russ Gremmel. His story is really inspiring, and I think a lot of younger investors today should appreciate the value of having a patient mindset. Enjoy Memorial Day, and I'll see you next time.